investors have observed, studied, and judged the latest round of central bank policy decisions, which, in essence, offered studious inactivity. In the coming week, company fundamentals will move back into the limelight, as around a dozen FTSE 100 firms and a good number of mid-caps will be reporting either full-year or first-half results or trading statements to the end of March. The two that particularly catch the eye are telecoms giants Vodafone and BT, although in some ways they may do so for the wrong reasons. This is because over the past year, they both rank 90th or worst amongst the FTSE 100 in terms of share price change. And over the past 5 years, they rank in the bottom 6 among the current list of FTSE 100 members who have at least been in the index for that long. Haleon and M&G are the two exceptions, and they've both coughed up share price decreases of more than 50%. This particularly turgid effort is down to a number of factors, which include, although not exclusively, intense competition in the areas of telephony, broadband, mobile and TV and content, footloose customers who are prepared to shop around and switch provider, tighter regulation from Ofcom. Ofwat may be getting in the neck for letting the water companies run up too much debt and provide a poor service and pay out a lot of dividends. But telecoms looks to be a sector where consumers are getting the better part of the deal relative to shareholders. You've also got indebted balance sheets, and as a result of all of the above, dividend cuts, which are really helpful for slow growth quasi-utility stocks like these. BT did it in 2020 and 2021, and Vodafone in 2019, and in fact Vodafone has already warned of another reduction in the coming year to March 2025. Both companies are led by relatively new chief executives, Margherita Della Valle at Vodafone and Alison Kirkby at BT, and the result should make for interesting reading, even if Vodafone and BT have the annoying habit of using underlying adjusted non-statutory financial metrics as their benchmark for performance. Vodafone's are going to be even more difficult to read than normal, as they will report the Spanish and Italian operations as discontinued units as they're being sold. The figures quoted here, though, still include them. Vodafone's first up with its full-year results on Tuesday the 14th, so we'll start there. The company has given 2 bits of guidance above and beyond its comments on the dividend for this year and next, and the numbers here and any steer for fiscal 2025 will make the headlines. The first covers Vodafone's preferred profit metric of adjusted earnings before interest, taxes, depreciation, amortization and lease costs, or adjusted EBITDA. Asset disposal again make comparisons tricky, but management had guided under the old structure to €13.3 billion for the year just ended, while the analysts have penciled in €13 billion, down from €14.7 billion in the prior period. A further drop is expected for the year just begun. The second bit of guidance covers adjusted free cash flow after capital investment, but before restructuring and spectrum costs. Here the guidance is for €3.3 billion, down from €5.3 billion in fiscal 2023, and analysts are looking for another drop to €3.1 billion in 2025. Again, though, that's under the old structure. Now, more strategically, attention will focus on the timing of the sale of the Spanish and Italian businesses for a combined €12 billion, and any updates on the Competition and Markets Authority's investigation into the proposed merger of Vodafone's UK assets with those of Three. The regulator, thus far, does not seem to welcome the plan. Margherita Della Valle hopes these deals will complete the reorganisation that she targeted back in May 2023 and will leave the company with a new 5-pronged reporting structure of Germany, the UK, other Europe, Turkey and Africa. Also watch out for any comment on the proposed €2 billion in share buybacks after completion of each of the Spanish and Italian deals. As for BT, well, they report 2 days later on the 16th, and Alison Kirkby reaffirmed full-year guidance alongside the third quarter update back in February. The FTSE 100 member expects growth in both sales and adjusted EBITDA. Consensus forecasts looking for 2.1% sales growth to £20.9 billion and a 2% increase in adjusted EBITDA to £8.1 billion, ahead of gains of around 1% in each to £21 billion and £8.3 billion respectively in fiscal 2025. In addition, the company expects capital investment of £5 billion compared to £5.3 billion the previous year, and free cash flow between £1 and £1.2 billion, down from £1.3 billion a year ago. Analysts think that capex will be flat and free cash flow up modestly in the coming year that's just begun. No changes expected in BT's annual dividend of 7.7 pence a share, and the firm doesn't run a share buyback programme. Watch out for updates on the £3 billion cost-cutting programme and the rapidly shrinking pension deficit, which has to be a good thing. After the merger of BT Sport and Discovery's Eurosport, no major corporate activity is expected, although the firm did recently move to quash rumours of a bid for AIM's Music Magpie. I hope that you and your families are all keeping well. Thank you for watching, and I look forward to seeing you again next time.